Hello folks, in this video we will gonna learn how to do the sensitivity analysis of a stock price. So after calculating the DCF model, you can find the sensitivity analysis of the stock price by changing some of the input variable in your model. For example, you are valuing for McDonald's company. So you got a stock price of McDonald's. For example, it is $130. So now you want to present how sensitive your stock price if you change certain input variable in your valuation model. So you know the key input variable in your valuation models are WACC or growth rate. So you can see how sensitive your stock price is if you change your key input variables. So let's go to our valuation model. So this is the valuation model that I have already created. So in this model, we already calculated the stock price, which is 146.4. So this is the DCF model. So I am not going to the DCF model in this video because this is a very time-consuming process to discuss in the same video the DCF and sensitivity analysis. So if you want to learn more about DCF model, I have another separate video about DCF model. You can explore the DCF model video. Okay. So based on this assumption, these are the assumption in our models, and these are the financial statement for the company. Based on the model, we calculated free cash flows. So these are the free cash flows. Calculating the free cash flows. These are the free cash flows for year 2025, 2024, 2026, 2027. And this is the growth of FCF. So our growth will be constant after 2027 forever at the rate of 5%. Okay, so this is our assumption. And based on this assumption, we got our horizon value, we got our value of the operation, we got our stock price. Okay, so what is horizon value? What is actually value of the operation? How do we come up with the stock price? This all has been declared in the DCF video. Okay, so if you are curious, you can actually go to the DCF video and learn about it. So after calculating the stock price, now we will gonna do some sensitivity analysis. So for example, our first sensitivity is how sensitive our stock price is if our WACC, one of the key input variable is cost of capital. Okay, so cost of capital measure is WACC, weighted average cost of capital. So if our WACC changes, how sensitive our stock price is. So to do this sensitivity analysis, we need to use data table. So if you are not familiar with the data table, so I will gonna show you how do you use data table in this stock valuation model. So first, let's create the range of the WACC. For example, let's put one rows empty so that we can put this as a reference cell or reference row. So 7.5%. So we are creating the range of the WACC to create our data table. So if you drag this, it will create your range. So we need a couple of more rows. Let's create a couple of more rows. So for example, in our model, we are saying that how sensitive our stock price will be from 7.5% to 14.5%. Okay. So to do this sensitivity analysis, you in the next cell above this first percentage, you will gonna take the reference cell of the stock price. So this is your reference cell. Okay. So now select this reference cell until the last percentage of your WACC. Select this portion, then go to the data, what if analysis, data table. So we talked about data table. So data table is a very powerful tools in the Excel. So in the Excel, you can use data table to calculate the sensitivity analysis. So after selecting data table, there are two options. One is row input cell, another is column input cell. So you will be a little bit curious which cell I will use, or whether I have to use both of the cell referencing or not. Actually, for sensitivity analysis, if your sensitivity inputs, this is your sensitivity inputs, so it is in the column, right? It is under one column, so you are going to select column. But if you put your number like that, for example, 7.5%, 8%, I mean, you put your number in the column row, then you're going to put row. Okay, so it is your column sensitivity. So we are curious about our WACC. So now you need to refer your WACC in our model. The WACC is B119. So put B119 because this is our model WACC. Hit OK. You're going to find how sensitive your stock price is based on the change of your WACC. Look, the very important concept is if your WACC is small, your stock price is high, because the stock price and the rate of return or cost of capital are invertedly or inversely related. If cost of capital goes down, the stock price goes up. If stock price or cost of capital goes up, stock price goes down. So look, our base cost of capital was 10%. So 10% stock price is 146.4. It matched here. Whenever your cost of capital is lower than that, you find that your value is maximizing. Whenever your stock WACC is going up, you are actually destructing your value. So this is one of the important consideration for a CEO or CFO. How do they actually manage their financing? How do they actually create their capital structure to create the value maximization? Okay, so this is one sensitivity analysis. So for practice, we can do another sensitivity analysis. For example, how sensitive your stock price is if your growth rate, that means your terminal growth rate, ranges from 2.5% to 7%, 7.5%. First, you need to put one actually rows below, because this will be a reference cell. So 2.5% to 7.5%. Create this. You can create as many as you want. Okay, I'm just, for the sake of simplicity, I am showing up to 7.5%. So this will be a reference row or reference cell. This is your stock price. So reference is stock price. Always remember, in the if you want to create the model, you need to do the cell referencing. You cannot put raw number in the Excel column. Then your raw number, your Excel will not going to work out. Okay. So now select this portion, then go to the data, what if analysis, data table. Again, this is actually under column, not in the row. So let me clarify when you're going to select row. For example, your numbers are like that: 2.5%, 3%, like that. For example, you are creating a row of your input variable, like it's a sensitivity. Okay. Now you are creating, let me take it a little bigger. Okay. So for example, this will be your reference cell. If you select this to this and go to the data, quantitative analysis, data table, now you will gonna select row because your sensitivity is under the row, right? If you go to the row, it is our growth rate, terminal growth rate. Go to the terminal growth rate portion. So we need to do little bigger. Terminal growth rate is here. This one is your growth of FCF, okay, 5%, or long-term constant growth of FCF. This is this one, okay. If you hit OK, look, your actually sensitivity has been created. So this is when you will gonna select row inputs, but the sensitivity actually looks better in the column. So this is why I prefer column sensitivity. So after creating the column of sensitivity, go to the quantitative analysis, data table. So since it is a column input cell, go to your long-term growth rate for free cash flow, hit OK. So the same thing actually created, but the presentations are different. Okay, so the reason I'm showing both rows and column, when we're gonna select row input cell, when you will gonna select column input cell. So this is the difference. Okay. Just for the sake of simplicity, I just delete that. So this is called sensitivity. So look, if your growth rate is 2.5%, your stock price is 87, while your baseline stock price is 146.42. That means if growth rate is low, stock price is low. That makes sense, right? If growth rate is high, stock price is high. Okay, so this is how you can create your sensitivity of the stock price and see and show different stock price based on the different actually input variable. Okay, so if you have any question about sensitivity analysis, feel free to ask me any question. If you have no question, you also can actually give a like, comment, or something like that. Thank you for watching the video.